One of the most popular investment factors is size, or more correctly, small size. Studies have shown that in the long run, stocks with a small market capitalization have outperformed those with a large market cap. Alongside market risk and value, size was one of the three factors in the groundbreaking three-factor model introduced by Gene Farmer and Ken French in 1992. The question of why small stocks outperform is the subject of heated debate. There are those who say it's down to risk. In other words, small stocks tend to be riskier than large stocks, and higher risk generally leads to higher returns. For some, the size premium is primarily a compensation for liquidity risk. Others prefer behavioural explanations. Investors tend to gravitate towards stocks they're familiar with, and they're usually the larger companies. Researching small stocks is difficult and expensive, and many institutional investors are concerned about liquidity constraints and market capacity. What about long-term performance? Well, small-cap stocks have generally outperformed their large-cap peers since the mid-1920s. But over the last 10 years, the performance of small and large caps has been very similar. For example, in the 10 years up to the end of April 2021, the MSCI ACWI Small Cap Index returned 9.73%. The parent index returned only slightly more, 9.76%. The Emerging Market Small Cap Index returned 3.82%, the parent index 3.96%. Again, not much of a difference. And what happened during the coronavirus crisis? Well, small caps fell even further than large caps when markets crashed in March 2020. But that reversed as markets recovered and small caps rallied more than large caps as the news on COVID-19 vaccines and vaccination programs improved. What then do we mean by small size? Well, the mean market capitalization of companies in the MSCI ACWI Small Cap Index is $1.5 billion, as opposed to $21.7 billion for the parent index. That's still pretty large, about twice the size of the mean market cap in the FTSE 350, for example. The definition of small cap is important, as the return dynamics of microcap companies are affected by limited capacity, high transaction costs, the lottery effect, dilution, and poor corporate governance. So let's compare the MSCI ACWI Small Cap Index with the MSCI ACWI Global Capitalization Index. A significant difference is the turnover of each index, 16.5% for the small cap index in the 12 months to the end of April 2021, compared with 4% for the parent index. On the positive side, the small cap index has a better Sharpe ratio, 0.43% as opposed to 0.37% since the year 2000. But dividend payouts are lower. The index also has a lower exposure to low volatility stocks. There is, of course, no crossover between the top 10 constituents of each index. What then are the advantages of tilting a portfolio towards small size? Historically, small caps have enhanced return while improving a portfolio's risk and reward ratio as measured by the Sharpe ratio. Small caps improve portfolio diversification while providing better access to the full economic engine and to the drivers of innovation and disruptive change. In the past, small caps have outperformed during periods of rising inflation expectations. Small companies have also performed better than their larger peers in the early stages of economic expansions. Again, it needs to be stressed that predicting future returns for the different factors is extremely difficult, but a steady exposure over the long term can reasonably be expected to prove beneficial.